Hey everyone, welcome back to Corporate Decoder, the place where we decode the boring corporate filings to find the juiciest insights. And folks, today we've got a real treat from AirSculpt Technologies Incorporated, or AIRS as you might know them on the NASDAQ. You ready to see if this company is still sculpting success, or if they're facing a bit of a deficit? Stick around. So AIRS has dropped its latest quarterly report, a 10Q for short, and it covers the period ending the 30th of September 2025. Now normally these reports can be a snooze fest, but we're going to cut through the jargon and give you the real story about what these numbers actually mean for the company and its shareholders. Think of it as your financial checkup, but way more interesting than your actual doctor's visit. Let's dive right into the big picture with their balance sheet. As of late September 2025, the company is showing total assets of about $186 million. That is down from nearly $210 million at the end of 2024. What does that mean? Well, it suggests they've been shrinking their asset base, which can happen for various reasons. Maybe selling off some older equipment or just not investing as much in new stuff for now. On the flip side, their current liabilities, the stuff they owe in the short term, are around $24 million. That is down from about $28.6 million. So they've managed to chip away at some of their immediate debts, which is usually a good sign. Now for the owners, the stockholders, equity stands at about $82 million. This is up slightly from around $79 million at the end of the previous year. So even though their total assets are down, their equity has managed to creep up, which suggests they've either been profitable or have managed their finances in a way that boosts shareholder value. Though looking at their income statement, profit isn't exactly the story right now. Alright, let's talk revenue, the lifeblood of any business. For the 3 months ending the 30th of September of 2025, AIRS brought in about $35 million. That is a pretty significant drop from the nearly $42.5 million they made in the same period last year. For the longer 9-month stretch, revenue was down to about $118 million. From over $141 million in 2024, that's a drop of about 16 to 18% respectively. Yikes. Losing that much revenue in just a year is definitely something to pay attention to. It is like if a popular restaurant suddenly saw a fifth of their customers disappear. And it is not just revenue that is taking a hit. They've reported a loss on impairment of long-lived assets. For the 9 months ending September 2025, this hit them for over $7 million. This usually means they're writing down the value of assets like equipment or maybe even some software projects because they're not worth as much as they thought, or they've decided to stop using them. They explicitly mentioned taking a big hit on their Salesforce software implementation and also from the planned closure of their facility in the United Kingdom. This signals that some big strategic bets or operational decisions might not be paying off as expected. And all of this, the falling revenue and those impairment charges, has led to a net loss. For the 3 months ending September 2025, they lost nearly $9.5 million. For the 9-month period, that loss balloons to almost $13 million. Compare that to the prior year, where they also had losses, but they were smaller, around $6 million for the quarter and about $3.2 million for the 9 months. So not only are they losing money, they're losing more money than before. This is not the kind of trend you want to see. This translates directly to their earnings per S-hair. For the 9 months ending September 2025, basic loss per S-hair is 22 cents. That's a much bigger bite out of shareholder value than the 6 cents lost per S-hair in the same period last year. It really shows how the bottom line has deteriorated. Interestingly, the number of shares out there, while growing a bit, is not the main story here. It is actually pretty stable in context of the revenue drop. For the 9 months of 2025, they had about 60.2 million shares on average. The issue is not too many cooks in the kitchen, it is that the pie itself has shrunk considerably. Now, companies often provide these adjusted numbers to paint a slightly rosier picture. Let's look at their adjusted EBITDA. For the 9 months ending September 2025, it was about $12.6 million. That sounds okay, but it is down from over $18.8 million in the prior year. So even when you strip out some of the one-off charges like depreciation and interest, the core business operations are still generating less cash. The adjusted EBITDA margin, which shows what percentage of revenue turns into this adjusted profit, has also dropped from over 13% to about 10.7%. This means for every dollar of revenue, they're keeping less for their core operations. And their adjusted net income is also showing a loss again. For the 9 months ending September 2025, they had an adjusted net loss of about $2.3 million, a stark contrast to the over $5.6 million adjusted net income they reported in the same period last year. This adjusted metric, which removes things like stock compensation and impairment charges, still shows them in the red. This is a pretty strong indicator that the underlying business performance is indeed struggling. Let's dig into what is causing this revenue slump. Management points to weaker performance across the aesthetics and high-end retail industries. This suggests that consumers are cutting back on discretionary spending and procedures like AirSculpt are feeling the pinch. It is a tough market out there right now for non-essential services. Now, the cost of delivering their services, things like physician and clinical staff compensation, medical supplies and facility rent, went down too, but not as much as revenue. For the 9 months, cost of service dropped by about 12%, while revenue dropped by over 16%. This means their cost of service as a percentage of revenue actually increased. From about 38.7% to 40.6%, this indicates they are not able to fully leverage their fixed costs like rent and nursing staff in their most expensive facilities. That's like trying to run a large kitchen with only a few customers. Your cost per meal goes up. Selling, general and administrative expenses, which include marketing, advertising, and corporate overhead, also saw a decrease, falling by about 15% for the 9-month period. This reflects a reduction in advertising spend and also a cutback in legal and professional services, potentially driven by cost. Reduction initiatives, however, with falling revenue, these expenses still represent a larger chunk of each revenue dollar compared to the previous year. Their total operating expenses across the board are down, but not enough to offset the revenue decline. This is why their operations swung from a profit in the prior year to a significant loss in the first 9 months of 2025. Depreciation and amortization actually increased. This is often due to opening new centers or expanding existing ones, which increases the value of their property and equipment. However, with the current revenue trends, that investment is looking less productive at the moment. And remember that big impairment charge we talked about, that $7.2 million, that really weighs down their operational results, turning an operating loss into an even bigger operating loss. Interest expense, which is the cost of borrowing money, has remained relatively stable, around $4.6 million for the 9-month periods. They've got debt, and they're paying for it, no surprises there. Let's talk about cash. As of the 30th of September 2025, AirSculpt had about $5.4 million in cash. That's down from about $8.2 million at the end of 2024. They also have access to a $5 million revolving credit facility, but their actual usage of that was zero at the end of September. This suggests they are not actively drawing on that line of credit. Looking at their cash flow statement for the 9 months ending September 2025, they used about $2.8 million more cash than they brought in. This compares to using about $4.3 million more cash in the same period last year. So while they are burning through cash, they are burning through it a bit slower than they were. This is a small silver lining, but burning cash is never ideal. Their operating activities provided $5.6 million in cash for the 9 months of 2025, down from over $8.6 million in 2024. This decline is directly linked to those lower revenues and profits we've already discussed. It shows that the core business generated less cash from its day-to-day operations. Investing activities show a much smaller cash outflow of about $2.3 million for the 9 months of 2025 compared to a hefty $10.5 million in the prior year. This is because they've scaled back on investments in new facilities or equipment. They mentioned primarily making final payments on a new location that opened in late 2024 and covering routine maintenance. Basically, they're not expanding as aggressively. Financing activities used about $6.1 million in cash for the first 9 months of 2025. This mainly includes making principal payments on their debt, totaling over $12.8 million. But they also raised about $14 million from a public offering. So while they are paying down debt, they are also raising capital, which is a common strategy when a company is facing cash flow challenges. Speaking of that offering, in June of 2025, they sold over 3.6 million shares and brought in about $13.8 million in net proceeds. They used a chunk of this to pay down debt, which is a sensible move. They also have this at the market program where they can sell stock periodically. They sold a small amount, some 124,000 shares in total across the first 2 quarters of 2025, bringing in a little over $264,000. This is a way to raise smaller increments of cash as needed, without a big splashy offering. Let's look at their debt. As of the 30th of September 2025, their total debt was about $56.9 million. That is down from nearly $70 million at the end of 2024. They are actively paying down their principal debt, which is good. However, keep in mind that the company amended its credit agreement multiple times. With the latest amendment in March 2025, this shows they were having trouble meeting their original financial covenants, those promises they made to the lenders about things like how much profit they'd make or how much debt they'd have. The amendments involved loosening those requirements and increasing interest rates under certain conditions, which is not a sign of strength. Now for my take, it is clear AirSculpt Technologies is facing some significant headwinds. The revenue decline is substantial, suggesting that the market for their premium cosmetic procedures is shrinking or at least becoming more competitive. The fact that they're taking large impairment charges on assets, like that Salesforce project and the closure of their UK facility, is concerning. It points to strategic missteps or an inability to adapt quickly enough to changing market conditions. While they are making efforts to cut costs and improve their marketing and sales strategies, the overall trend shows them moving from a position of moderate profitability to larger losses. Their adjusted EBITDA is down, and their adjusted net income is also showing a loss again, which tells us that even when you try to smooth out the bumps, the core business is under pressure. The cash position is not alarmingly low, but given the losses and continued negative cash flow from operations, their ability to fund prolonged downturns without further financing is questionable. The management seems to be focusing on stabilizing revenue and cutting costs. But the question is whether these measures will be enough to turn the tide quickly enough to avoid further financial strain. The debt restructuring also signals some underlying financial anxiety. So what is the verdict? AirSculpt is in a tough spot. They have a strong brand and a unique procedure, but they are battling a challenging economic environment for elective services and seem to be grappling with some internal strategic execution issues. The next few quarters will be crucial to see if their stabilization efforts can actually turn into growth or if they will continue to be a company fighting to stay afloat for investors. This report signals caution, alright? That is our breakdown of AirSculpt Technologies Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community analysis and discussions. Thanks for watching. See you next time.